Welcome to the My Money, My Lifestyle podcast, where we discuss all things money, because whether or not we like it, money matters. I am your host, Maya Fisher-French. Now, interest rates since the beginning of this pandemic, which we are now nearly 2 years into, have actually fallen by 30%. So this is great for those of us who borrow money and with bonds and debt repayment, but it's pretty dire if you are somebody who's investing for cash or you've been relying on income from cash investments. So our conversation today is around whether cash is now trash or if it still has a place in your portfolio. And to provide some expert insights, I'm joined by Mabule Setwaba, who is Corporate Cash Manager at Investing Bank Limited. So welcome, Mabule, onto the My Money, My Lifestyle podcast.
Thank you, Maya. It's great to be with you on the show.
So, Mabule, one of the reasons I wanted to actually have you on is I remember writing an article in 2018 all about the way cash had outperformed. I mean, it outperformed not only the inflation, it outperformed inflation by 3 or 4%. I mean, it was giving real returns. It was outperforming the stock market. You kind of had wanted to sit in cash, but those days are very much gone. And I would argue probably that the 2019 was a little bit of an anomaly anyway. Would you agree?
Yeah, look, it definitely was a very interesting time, and you're correct. And in preparation for our conversation, I looked at some stats going back to July 2019. For the 12-month period, cash had done 7.3%, and you compare that to the All Bond Index, which at the time was at 8.1, and the All Share, believe it or not, was at 2.2%. So you actually had the riskiest asset class out of that grouping. Given the lowest yield. But rates have definitely come down quite significantly. And we all understand with the context of COVID, I think the Reserve Bank needed to take some extraordinary measures to try and protect the economy and to get things going. But for depositors and cash investors, it does mean you are getting a much lower yield. So, but no, Maya, I don't believe cash is trash, and there is always a place for cash in your portfolio. And I can certainly understand the perspective of someone who holds a cash position and is looking to live off that money. If you look at what most money market funds are returning at the moment, it's about 4%. And with the latest statistics, inflation is sitting at about 4.4. Now, that's obviously not an ideal scenario. However, you do have investors who will hold cash, for opportunistic investment. As things are moving in the economy and in the market, it really does make sense to have a portion of your portfolio sitting in cash, liquid, and ready for you to take advantage of opportunities as and when they arise in the market. Another trend that we see is where clients or investors have gone into some higher risk type of investments. They tend to actually use cash as a mechanism to neutralize the risk. So you may have one or two things where you're going a little bit aggressive in the market, but hold a portion of your portfolio, which yes, is lower yielding, but on a portfolio basis lowers the overall risk that the client is exposed to.
And you just think about it also almost as a lifestyle risk. And I suppose I'd call that your emergency fund, but I think COVID showed that to us. You don't always want to have your assets sitting in a long-term growth fund and then life happens and you suddenly need to access at least 6 months of your living expenses. So I suppose there's always a place. And I think that if you understand cash as the risk-free investment, the one that you can kind of count on and sleep at night, knowing that you at least have that as part of your portfolio, it allows you, as you said, to take risk on your other investments. So it actually allows for risk, I suppose, in a way.
Well, it does, and interestingly, you use the word risk-free. I always say it's on the much lower end of the risk spectrum. And investors really need to be incredibly careful about that. We see clients who have gone into investments like money market funds, which historically have actually performed really well, perceived to be risk-free. But when there are credit events that happen in the market, you may remember the African bank, default on some of their bonds. That actually translated into holders of those money market funds losing a small portion of their cash. So you assessing the risk of the vehicle that you use for your cash investments becomes really important in that context. Bank deposits, you are exposed to whichever counterparty bank you are depositing with. And those really are supposed to be capital protected to the extent the bank continues as a going concern. So yes, I think assessing risk in that equation becomes an incredibly important proportion in the equation.
And I think that you're touching on, your money market funds versus your fixed deposits and that. And so maybe just for our podcast listeners, I find often people get confused between what those all are. So maybe a fixed deposit is, as you said, usually with a bank and a single bank, and you put the money in there and you agree to a term that you're going to leave it in there. And a money market bank account, does that work in the same way? Is it just a single party risk there?
Yeah, so I do think this is one of the areas where you have to look very carefully at the terms of the product that you are going into. Just because a product is a bank product does not mean it is bank guaranteed or capital protected. So yeah, you do get your normal deposit products, which may be prime linked, notice deposit, fixed deposits, where the bank backs that product. What the banks have done in recent times, to really compete with the rest of the cash industry, was to create deposit products which references money markets to calculate the return that the depositor earns. So in that scenario, because the deposit is sitting on the bank's balance sheet, then that depositor enjoys the protection and the capital security that all the other depositors of the bank do. Where you need to be careful is where perhaps you may have a structured cash investment product. It might still be with a bank, and it may reference a few other things other than just the money market, using the money market as a reference point. And that is where there could be potential risk. But typically, yes, the money market deposits offered by banks are actually deposits as defined and enjoy all the benefits that other depositors do.
So maybe you also explain then what a money market unit trust is, because that's obviously very different. So now it's not a single bank risk, and it's the money market unit trusts that were specifically knocked by the African bank scenario, for example. So maybe just explain how, because those are definitely they tend to have better returns. They do tend to outperform your money market bank accounts or your fixed deposits, but every time you outperform, you tend to have risk. So maybe just unpack that.
I think that's an important thing, Maya. The risk return relationship is something that's very difficult to get away from. And what happens with the money market unitized funds is the portfolio manager will go out into the market and look for various interest-bearing assets. They may invest actually in bonds issued by banks. But they may also invest in things like corporate bonds, which are slightly higher risk in their nature. And that is actually how they are able to achieve the higher return. So between the mix of the underlying bonds that they invest in and also playing with the term structure, you could find a manager who invests in slightly longer dated paper, which then helps the fund as a whole to give a higher return. But with all of those dynamics, there is a degree of risk that is being introduced. Now, the unit trust makes it easier for a retail investor to access that investment. Essentially, it is unitized. And instead of having to invest R1,000,000 at a time, a retail investor is able to purchase R1,000 monthly or 10,000 rand. It makes it a lot more accessible. So yes, the return is higher. But then there is an inherent risk. And that's something there's an underlying risk rather in the product. And that is something that most investors don't really go and investigate. You look at the return of the fund, and it really is that absolute return that people see that attracts them into that fund without necessarily understanding or assessing what are the instruments which are held in that fund. I think that's That's one thing that depositors and investors need to be careful of. The other thing is of course fees. When you do go into unit trusts and alternative investments, there may be platform fees, there may be, and there very likely are, management fees because the fund management team that does the research needs to be paid. And those things actually can erode the return that an investor gets. So whereas with a bank product, typically direct, I think investors still do need to look at what fees they are being charged in that scenario. Just one point that I want to highlight, Maya, to be competitive, what a number of banks have done is they've looked at the return that is being offered by various money market funds. And you find a scenario where a bank looks at the top 5 performing money market funds or the top 4 and takes the average of those funds to determine the return on their own bank deposit products. And the net effect of that is actually the investor is able to pick up a higher return, which is in line with money market funds, without necessarily picking up the commensurate risk. So I think that's a very innovative, product development that's come through in the banking sector that does help investors in a way get slightly better returns.
Well, this search for yield, which is in many cases, or trying to attract deposits, especially retail deposits. So we can maybe just unpack that a little bit. That with Basel III coming in, banks, the way that the kind of deposits that a bank has to now hold changed, and it was a lot cheaper for banks to go and get those deposits from depositors, I suppose, than going and borrowing it from other banks or from the Reserve Bank. So this was, I think, also drove, if I remember correctly, in 2018, this was actually what drove so many of those deposits. That's why the interest rates. That's why you were getting, your bank was giving you such great interest rates, because they were looking for deposits. Has that changed now? Are you guys still looking for money?
I think more so. Like I do think that the interest rate environment around 2018 was driven by the broader macro factors, but regulation always plays a big role. And historically, the way banks funded themselves was to go to a handful of really large institutional investors. And when the Reserve Bank looks at this, what it does is that it causes systemic risk. There are a few large players in the market where banks are reliant on to generate fundings. And also from the bank's perspective, if you've got one large institutional investor who takes out 10 billion rands or whatever the case might be, that changes the structure of your balance sheet materially. So going back to actually the global financial crisis of 2008, there's been a greater emphasis on the need for banks to generate or to attract a greater proportion of their deposits from the retail market. And that's where you really started seeing the shift and banks being innovative in trying to get that funded. So from a Basel perspective, as you correctly point out, we talk about the efficiency of the funding that you generate. It is much more attractive for a bank to have 100,000 depositors who are giving us 1,000 rands each than one investor who gives us 100 million.
And that's also quite key with Basel III, is that they look at also the risk or the stickiness of the money. So the longer the longer the deposit, or it's the fixed deposit, the better the quality of the deposit is in terms of the regulator. So we see again, the longer you're prepared to invest your money for, sometimes the bigger upside. And you even spoke about longer dated paper being used to enhance returns. So how does it, from a retail investor's perspective, how do they take advantage of that to make sure that they at least trying to find, even if it's just a 0.25% more than they're currently getting?
Yeah, so banks will reward depositors for the term structure is the language that we use. Maybe just to take a step back, you spoke about borrowers of the bank. Well, typically, if you think about the assets that a bank funds, you'll have auto loans, home loans. Those are 20-year loans that are being made. And on the other side, the deposits that you are getting are overnight or 1 month type of deposits. So there's a very significant mismatch between the assets and liabilities of the bank. The bank is very strongly, therefore, incentivized to increase the term structure of our deposit base, which then means we have got a greater appetite for paying a higher return for that. So for depositors who are looking for a yield enhancement without necessarily moving up on the risk curve, one very effective way of doing that is by increasing the duration of your deposit. So moving your money out of call deposit or 30-day deposit, looking at going into 6 months or 12-month type of deposits. And some people go as far out as even 5 years. That will create an enhancement to the return that an investor can get. But Maya, a very important thing to always consider, with things like that is the interest rate cycle that you are in. I think
I was about to ask you exactly that. Yeah, I was going to say, you want to fix now. Where are we at the interest rate cycle? Yeah.
Yeah, that's the interesting thing, because in as much as the market gives an indication of where we think rates are going, and in pricing these fixed deposit products, banks take that into account. But if you fix your money for a year and interest rates go up by 25 basis points and then another 25 shortly, you might actually find yourself earning a slightly lower return than you would have had you waited. So in an environment like this, it actually is, tactically clients go into probably notice deposit products, become a little bit more effective and an efficient way of getting that yield pickup. Because with a notice deposit product, what happens is you can give either 30 days or 60 days or 90 days notice. Now, your money isn't locked in for a 2-year period or a 5-year period, but in 30 days, you can give notice to say, I need to withdraw the money, I need to switch out of the investment and go into something that gives a higher return. So that's something that's always worthwhile, for investors to think about. We've also got step-ups. Step-up deposit products is you put your cash down today. If it's invested for a 30-day or a 60-day period, you get maybe a 5 or 10 basis points increase to the rate that you're earning. So, there are a few things that investors can look at. Instead of just going fixed or staying call, it's a good time to be considering things like notice deposit products and step-up alternatives.
And I know some of the banks, I think Investec's one of them, offer also prime linked. So if the prime rate moves, you will move with the prime rate as well.
Yeah, and I think that's the benefit when you're in this kind of market cycle. So you and I spoke about the money market funds, where the asset manager might lengthen the term structure of some of the underlying assets in that fund. The disadvantage of that is that when rates do move, it takes quite a bit of time for those underlying assets to reprice, and therefore for the investor to get the full benefit of the rate increase. Whereas if you are in a prime linked product, typically as the Reserve Bank increases the prime rate, so do all the banks, and you get the immediate benefit from that.
So it's definitely a time to be, you certainly in 2018 wanted to lock in, right? But now, because it was so high, but even if you didn't know COVID was coming, it was quite obvious that those rates were really high. But I think now, what's your gut feel if I had to put your head on the block by the end of, within the next year, what kind of rate hikes do you think we could see? Well, we won't hold you to it.
It's a little bit dangerous for me to go down that path because I'm not an economist, Maya. But what I will say is that there seems to be, when you look at where the overnight lending rate is between the bank, the JIBAR rate, you can actually see that rate has been increasing, which tells you that the banks do expect a rate hike. Probably 25 basis points is what we would get if we get anything in Q4 of 2021. But the inflation rate has also been rising, at 4.4. It's still very well within the band. There is a degree of nervousness in the market. If the SARB hikes rates too quickly, our economy is still very fragile. So that might be a reason for them to hold back and defer it to next year. So if I had to put my head on the block, I would say probably will be neutral still in the last quarter. I think I'm going against the market because 25 basis points seems to be priced in. But yeah, we don't try to take a view on the rate market. We really develop a range of products which enables our clients to be able to put their money away safely throughout the market cycles.
Well, I think it is safe to say, as a bank, that we are moving into an interest rate increasing cycle. So therefore, the strategy of a notice deposit, you're not perhaps locking in for 5 years, perhaps linked prime linked accounts. That's probably the way you should be looking in this specific environment. Now, when that rate increase comes and how much will be, we won't predict. But I think we're all comfortable. We're not about to see a rate cut anytime soon.
I think there's definitely consensus that we are in a rate increasing cycle. I haven't seen any market commentators talking about a cut. Look, we are at multi-decade lows at the moment in South Africa, and I think that's a very interesting dynamic. When you think about the psychology of our investors. If you look at the average interest rates in South Africa between 1998 and 2021. That was sitting at 12.13% over that period. And what we've seen over the past, call it 5-6 years, we had been at about 7-8. That's what people were able to get out of cash investment products. And being where we are at the moment, there are two factors at play. You've got people who did a lot of their financial planning in an environment where they actually expected rates to be much higher than what they are. Now, instead of sitting and adjusting lifestyle, what actually then tends to happen is that investors start reaching for yield. So they move out of cash positions and they go and invest in something else because I really need that 7% return, which is what I expected. But the risk with that is if there is something that goes wrong with that underlying asset, you actually suffer capital loss. And not only do you forego the interest that you would have earned, the return, but you lose a portion of your capital base. So again, the core principles around the risk-return relationship is something that investors always need to bear in mind.
Well, I mean, certainly you look at the bond market, and I mean, it's very attractive relative to cash. But of course, if we default, becomes another whole thing. So yes, there's a risk that's being priced into our bond market, and you can't pretend there isn't that risk. So I suppose that is it. It's all about risk and return at the end of the day. But
and there's the daily volatility that comes with the price movements in those bonds. I think again for your conservative investor, someone who really is possibly approaching retirement, to the point we made earlier. What you really want is to know that if I put down 100,000 rands, I am going to get a return, firstly, but certainly I would like to get my capital back. And when you find yourself in an environment, whether it's in bonds or equities, where there is exposure to volatility of that capital, that really is a materially different risk appetite that's required from an investor.
And I must say, one of the things that I also been looking at or considering, because my mom's a retiree, is actually using, and I must say, I sometimes get into trouble. I think I have gotten in trouble with Investec before for saying I'm not a fan of tax-free savings accounts for cash. I know you have a tax-free savings account cash product. But for me, a retiree, it's actually a brilliant product because you can build up your cash in a tax-free savings account, because cash still gets taxed. Yes, 23,800 if you're under 65, and I think it's 34,000 odd you can earn tax-free. But when you've got maybe 500,000 rand sitting in cash, as a retiree, you start paying tax on it. So building up that balance in a tax-free savings account as a retiree, I think can be a really great strategy.
Yeah, look, I mean, I think, and that's where really good financial planning and advice plays a big role. I spoke about managing costs and managing, your potential tax liability that comes with your investment. it really is important for depositors, investors, to take good advice, to really look at it very carefully, and make sure that they minimize the friction costs, in investments. And sometimes investors are tempted to also switch. I'll sit in one product and I see something that's performing quite well. I switch into a different product. But by doing that, you're probably losing 5, 10, 15 basis points every time you are moving that money around. It doesn't feel like a lot at the point when it's being done. But when you look at it cumulatively and over a longer period of time, it becomes very important. So absolutely, proper tax planning, considering tax-free savings, is a very good strategy.
And one thing I want to ask you to end off, talking about planning, is, foreign cash, foreign exchange cash. When you look at, you get zero interest, like nothing. Okay, so you think our interest rates are bad. I think in Germany now, I've got a friend who lives in Germany. He actually has to pay the bank. He gets back less than what he puts in. So they say, okay, you can leave your money with us, but we're going to charge you for it, and you don't actually even get any return, or get less than your money back. So do you think that there is? What are your thoughts about why would somebody sit with cash offshore? Like in cash?
Yeah, so firstly, I mean, with South African's externalization of assets has been a very strong trend over the years. And looking at publicly available information, in 2020, 150 billion rands left South Africa. And that is actually only through the intermediated market. And when we analyze where that money
so I have to stop you there. So the intermediate markets, this is financial planners and advisors.
This is through financial planners, advisors, treasury outsourcers. That's
150 billion rand.
Billion. With a B.
Not corporates. This is South Africans externalizing their assets.
There will be some corporate money that's in there, but it's going to exclude the large corporate transactions that are done. So the stats that we look at is provided the facilitation of the externalization was done by an advisor or a forex intermediary. So it excludes your large corporate flows. Yeah, that's correct.
Okay, that's
so
a big
very, very significant amount that has gone. And when we look at where that money has gone, a lot of it has gone to, offshore bank accounts. And granted, Maya, that money doesn't sit there forever. I think a lot of it might move on for onward investment after a period of time. But you asked a question around, why would people do that? There are a number of factors. The one is around SA Inc. risk. We talk to a lot of clients who say, I actually need to diversify a portion of my portfolio away from South Africa. And even if I am earning 0%, I am quite happy to do that. The second is a school of thought that says, well, historically, the rand has always depreciated. So you may say that I'm getting 0% in dollars, but after 5 years, when I convert it back and the rand is depreciated, actually I get a little bit of margin. Now, I think it was an interesting time for that philosophy earlier this year when we strengthened to about 14 or 13.80 to the dollar, because a lot of those that weakness had been reversed. But it's a very strong theme, and what we see, and we were just talking about money market funds in a South African context, is actually a number of clients investing in offshore money market funds. So still not looking to go into high risk investments, but rather putting it in cash and near cash solutions. So you'll see the various banks in South Africa also offering dollar-denominated savings products. And what we have done recently is to actually create a dollar deposit product, which also references US dollar denominated funds. So very similar to the rand environment, where you take the performance of the funds offshore and you use that as a proxy for the kind of return that you're going to pay investors. So I think there's going to be a bit
at the moment. Like, what percentage are you getting?
At the moment, instead of getting zero or having to pay the bank, you are getting about 25, 30 basis points on your cash. So, I mean, that is at least a positive return instead of being negative. You know, we expect also that globally that rates are going to be going up. So as the Fed hikes rates and, you know, we'll see SOFR and the other benchmarks starting to tick up, those products will also start yielding a higher return.
Well, great. Thanks so much. I think that you've given us a lot of food for thought. And I think for me, just to sum up, you know, cash plays a very important role as part of your insurance policies, actually. So, you know, it's there for you know, it just says, right, I've got that amount of money that is just banked, so to speak. And I think that's also where the offshore is playing a role. People may invest even in equities offshore, but they still want to know that, you know, if I need to leave, and I think I don't even want to go down that road. It's such a, you know, emotional conversation, but a lot of people feel safer knowing that there is something there if they need it. And I think that's the role cash plays. But it doesn't mean you can make it, you know, you leave it to be lazy. It can still work for you. And so hopefully get some tips on that.
It definitely can. And, you know, I don't think we advocate for, I don't think any investor can, you know, successfully grow their wealth by investing purely in cash. But it really goes back to the conversation we had right at the beginning about the place for cash in your portfolio. So, you know, as people are in different life stages and are thinking about their needs and their tolerance for risk, appetite for taking on higher risk in investments, it becomes important to consider how much cash you should be holding. And you know, you need to consider emergencies, but you also do need to consider the things that you are planning for. It's not just people who are nearing retirement, but you may have children who are going to be going to university next year or going overseas to study there. To make sure that you have got sufficient liquid funds to manage those expenses as they come up becomes a very important part of financial planning and well-being.
Well, thank you very much, Mabule, for sharing that with us today.
Thank you, Maya.